Welcome to your weekly market update. We are unfortunately seeing interest rates at their highest level since 2007. That was 16 years ago, but there are some good signs ahead, and I wanted to share some of them with you. Interest rates have moved from about 7.5% to 7.875. Depending on credit scores, we're starting to see some in the 8% range. So if you look, there is a report that is now required by any company that has more than 50 employees or more than 100 employees that they're going to lay off, that they have to give 60 days notice before that layoff. And if you look at this chart, the direction of jobless claims always follows, did in 2023, did in February 2023, it eventually follows once there's a spike. So jobless claims means unemployment. Economists and the Fed know the only way that inflation is going to get contained at this point is by wages stopping to climb. So there has to be a spread so people stop paying for things at these higher prices. Then the suppliers and all the retailers will have to bring their prices down. So the only way that happens is job loss and wage shrinkage, which is unfortunate, but that's how it works. So you can see this has spiked up immensely. So there's lots of layoffs coming. There's lots of plants closing. Terrible sign for those people. Great sign for inflation. So once this starts to go up and unemployment goes on the rise, we will see interest rates and mortgage rates come down. So just to show you where the spreads are right now, this is back in 2007. The Fed's funds rate was at 5.125. We just hit the 7.75 to 7.875. That hasn't been here since 2007. The federal funds rate today is actually higher, 5.375. So there's some spread there. The Treasury bond was 4.86%. That you can see that is dead even of what it was in 2007. Now the 30-year mortgage rate is much higher. It's a full percent higher. And the reason why is the thought process. Remember in 07, we were starting the financial crisis. We know rates are going to come down. We know that these mortgages we're writing right now are short-lived. So they won't be on any bank's mortgage lender, mortgage servicer's books long. So there's a premium that Fannie Mae and Freddie Mac put on those notes so they can make money by still writing mortgages. So you can see that spread is a full percent. And when you look at the 30-year note versus the 10-year note, you can see that spread in there. So it's just time that we have to wait for these rates to come down. I'm going to stand by with the housing starts and permits. You're starting to see less homes come on the market. That's going to amplify and intensify our housing shortage because there's less building going on. Remember, there's 2 million home formations every single year. That's about the average. And we're not even building, or I should say completing, 1 million homes. So the starts are elevated, but the completions, projects not being finished, projects pulling permits, but deciding not to build. I have a development deal I'm doing right now. I got to see what the costs are, and we might not build. We might sit on the land. So we have the permits to build, but if the costs don't make sense because of the elevated interest rates and we're not going to have a return on our product, then I'll just sit on the land. So that's what a lot of builders are doing right now. So where does this leave you? This leaves you with a great time to buy. This leads you with an excellent time to be aggressive in your negotiations. There's less demand out there, which means you can negotiate with the seller for some credits. You can negotiate the price down, perhaps. You can ask, I think most importantly, for a 3-2-1 or 2-1 buy down, so interest rates are lower. So we're seeing rates on the 3-2-1 buy down at the low 5, high 4% range right now. If you'd like more information on that, give us a call. And thanks for tuning in to your market update.